What we have here is the financial statements of Ultratech Cement that we have put in. The profit and loss statement and the balance sheet has already been put in. We'll put in excerpts of cash flow today itself in the while doing this analysis. But the idea of this is that we should be able to do ratio calculation and then some sort of a ratio analysis, which will answer mostly the question on why are we witnessing a certain trend in the numbers, right? So if a ratio is going up or is a ratio is going down, at least hypothetically, we should be able to arrive at some sort of an answer on this. And that is what this particular ratio analysis exercise should tell us. Remember, when we are calculating ratios and we are trying to find out what is going to be the growth rate in general or what numbers are, if I state that the company has grown by so and so percent, 10%, that is not analysis, that is observation, right? So if I say that sales of this company has grown by 12% or 13%, that's an observation, right? The why of this, why has sales grown by 12%? Has the same happened in the industry? Is this more than industry or less than the industry? Is where analysis comes in, right? That's what eventually we are supposed to do in our project. That will give us more insights about what the company is going to do. Today we are going to discuss some part of it, and we'll try and kind of see if this can be replicated across the projects that you are going to do during the course of your AFSA program, right? So let's begin with this. We are going to do the calculation of ratios for Ultratech Cement. We're also possibly going to look at growth numbers for the company over these years and try and find out what's happened to the growth numbers that we look at, right? We are going to also kind of calculate some data points on the ratios and the cash flows. If you click on this ratio analysis sheet, you will find a whole host of data points which are available that we need to calculate, and the formula for calculation is also given there. So for all practical purposes, we are kind of going to use this set as our calculation set. We're going to calculate the ratios based on the formulae which are given, and then we discuss our implications on how this is going to work, right? So let's start one by one. We start with turnover ratios. Inventory turnover ratio is being discussed as sales by inventory. We'll use net sales. So net sales divided by, on my balance sheet, do I find the inventory? That's under current assets. That's my inventories, right? Similarly, the receivables turnover ratio is going to be net sales divided by, on the balance sheet, trade receivables. Similarly, payables turnover ratio, I will find out sales divided by payables, which is on the current liabilities side, trade payables, right? That's the calculation for these three. Let's try and drag it ahead, and we get the turnover ratios for both inventory, receivables, and payables, right? What do we do next? Now, the next part that we do is basically we calculate and convert this in terms of days sales outstanding. For that, we need to just take 365 and divide by the respective turnover ratio that we see here. So we use 365 divided by the numbers here, and practically I can drag it on this side and I can drag it down, right? Now, what does this mean? We have this in terms of number of days. This essentially says that roughly about 40 to 45 days of sales is outstanding as inventory. About 15 to 23, 19 odd days on average of sales is outstanding as receivables, which means bulk of the payment occurs at the time of sales. Only a few days worth of sales goes out as receivables. And payable days is also about 44 days or something, right? Now, cement is a B2C business largely. So less receivables is explained, right? So less receivables is a straightforward point out of that, is because if I go to a cement shop, they're not going to give me cement without me making the payment out of it, right? So for all practical purposes, less receivables is understood. Whatever receivables are coming are probably coming because the dealers may pay with a little bit of a lag sometimes, and there may be some chunk of the sales that might be happening to corporate guys, right? So that's with Ultratech Siemens. This thing, inventory is low. Now that seems odd because manufacturing businesses typically run inventory, possibly because of short shelf life of cement. Remember, cement can't be stored for too long. So essentially, if the shelf life of cement is small, you would have inventory of about 1.5 months. If you think about it logically, you can't really store cement for more than 3-4 months. It starts giving away in terms of the quality that is there in the cement that you're stored. So cement is typically consumed immediately or within the next month and a half of production. So that's the net amount of inventory that they carry in terms of their total numbers, right? Let's calculate the net working capital numbers. So what is the net working capital numbers? There are two ways of calculating it. One is we take all current liabilities and take non-cash current assets. So we take total current assets minus cash minus current investments. Why did we do current investments as well? Because that's in, let's say, liquid mutual funds or liquid bonds, which is also a form of cash. We have to remove cash in our calculation minus total current liabilities. That's my net working capital calculation, right? Net working capital is negative. So the company works with negative working capital. And what is the net working capital turnover ratio? That's basically sales divided by this number, right? So that gives us a negative number. And obviously the negative number moves a lot, which is a little bit odd because ideally you would want stable working capital, but this seems to be not stable. And that's what we need to probably dig a little bit deeper into as to what is really making this significantly negative in this year. Is it because so 30 and 26 kind of seem in line, but every second year this net working capital turnover ratio goes down dramatically, which means there's something in the payable side or like current liability side which increases dramatically over this period. So we see in the last year, short-term borrowings have created this change. Short-term borrowings have suddenly gone up in the last year, and that basically is an interesting point that we need to check and capture what's possibly happening there. In the year before that, essentially some of the numbers with respect to the movement, other current liabilities had jumped up a lot. So that was 2500 right from 1600, and that possibly caused a little bit of a move. Again, short-term borrowing had picked up in that particular year as well. So why is short-term borrowing going up is possibly the next stage of analysis that comes in, for which we'll have to dig into reports of the industry and reports if the company has revealed anything. But we have at least isolated the cause here that seems to be changing this scenario. Net working capital in days is inventory days plus receivable days minus payable days, and we'll find that this is what is called as the cash conversion cycle, fairly stable over the last 3 years, stable cash conversion cycle, right? We have negative working capital, but positive cash conversion cycle is because cash conversion cycle only looks at inventory, receivable, and payable. Working capital looks at other assets, other current assets and liabilities as well, which may be causing the working capital to become negative. Provisions, etc., also come in working capital calculation, right? So that's the discussion here. Cash conversion cycle seems stable, which means the company seems to be managing the stuff well. The only change that occurred here, and post that it has been fairly stable. If you look at the numbers over the last 3 years, the numbers on each of the receivables, payables, and inventory days have also been fairly consistent, which is a good management skill that the company has, right? So that's these data points. Let's calculate some of the profitability and return ratios. Profitability ratio is EBITDA by net sales, or I can take total operating revenue here. And then we have EBIT by sales. So EBIT divided by total operating revenue. And then we have net profit by sales, which is the final profit number, PAT, divided by the sales number. Now, what do we see in these parameters over the years, right? So EBITDA declines, EBIT declines, and consequently PAT margin also declines. We have a declining EBITDA, declining profitability. Why is that happening? We do need to find out why is that happening. If we search for this a lot, let's look at the P&L first. We realize that when we look at the profit and loss account, sales seem to be going up, right? Sales seem to be going up over this period, but the costs also seem to be going up over this period. So what exactly is the cost that is causing sales to go up, but EBITDA to remain almost stagnant? EBITDA went up in the first few years, but then some of these data points moved faster than what sales would mean. So for this analysis, what we are going to do is we are going to put in a column for CAGR, right? Compounded annual growth rate. And remember, this is CAGR over 3 years, 12 to 13, 13 to 14, and 14 to 15, right? So 1 year, 2 year, 3 year is what we are looking at. Let's look at the CAGR in sales over this period. So I take the final value divided by the initial value raised to the power 1 by the number of years. How many years? 3, right? Because the first to the second is considered as 1 minus 1, right? Let's understand what formula have we chosen. If sales were 100 and they were growing at a growth rate of G for 3 years to become 200, what we are doing is calculation of G, which will be 1 plus G to the power 3 is equals to 200 by 100. Take 3 on this side, so we have 1 by 3, and G is equals to 200 by 100 raised to the power 1 by 3 minus 1. Make it generic, that's the final value divided by the initial value raised to the power 1 by n minus 1 is going to give you the CAGR. Correct? That's the formula that we have plugged in here. Final by initial raised to the power 1 by 3 because there are 3 years. And that gives us the calculation. Let's see what that calculation number is. In percentage terms, a sales CAGR of 7.8%. Now, some of the costs must be growing at more than 7.8%, right? Some of the costs must be growing at more than 7.8%. Let's also italicize this and change this in terms of the color so that we are aware that this is a growth number. Let's do a Control C, Control V, employee expenses, power and fuel expenses, freight and forwarding expenses, and other expenses. Now you realize practically all expenses with the exception of power and fuel expenses have gone up more than what sales have gone up by. So practically employee expenses have gone up more, freight and forwarding expenses have gone up more because possibly diesel charges have gone up more. And similarly, other expenses have also gone up more. These are the bigger components, so we are only worried about these bigger ones. Leave the smaller ones out, not necessary for us to see. That results in an EBITDA movement of only 0.38%. And if you go to PAT, we'll see a negative movement here. Right? If we look at the PAT number, we'll see a CAGR which is negative here. Why is that? Let's see. Interest has gone up dramatically. Depreciation has gone up almost at the same clip as sales. Sales went up at 7.8. So depreciation also kind of moved at 7.9. That's not the worry. Interest has gone up more over this period, possibly because the company has taken more short-term loans, right? We saw more short-term loans in the last year. Last year, more short-term loans, more debt, more interest component that comes in. That is also causing the profitability to decline. So now we get the declining profitability. The why has been sort of answered. Costs going up more than sales and interest going up. In fact, interest going up is more on the PAT margin front. Interest going up here, right? So we have a sort of an analysis on why this is happening. Let's look at return on equity. That's net profit divided by net worth, which is on the balance sheet, right? Total shareholder funds. That is the net worth that we have, correct? Let's see what's happened to return on equity. That also seems to have fallen, right? So ROE going down. You can isolate why is ROE going down by dividing ROE into 3 components, which is the Dupont analysis that we can do. We'll do that as we go along, but ROE seems to be going down. We'll try and find out what's happening there. Asset turnover ratio is my sales number, total operating revenue, divided by my balance sheet total assets number, right? So let's put total assets here, and sales by total assets is what we are looking at. This is typically seen in terms of a number and not in terms of percentages. We find asset turnover has gone down, which means assets have gone up, sales haven't really increased at the same clip, right? Asset turnover ratio going down could be because of two reasons. Going down is typically because of two reasons. CapEx, capacity has been expanded, but sales have not yet materialized because of that, or declining efficiency. So we have to figure out which one is the major reason as we go along. That'll tell us what's possibly happening with these ratios as we look at them, right? Let's look at return on assets. Here we take EBIT, EBIT, that's EBIT, and divide this by total assets. And similarly, you look at EBIT, EBIT divided by bracket open. I have to find out shareholder funds, which is this, plus the debt funds that have come in. So I take all the debt funds here, not just the long term, but I'm taking short term as well. You can choose only to take the long term, but I have taken both long term and short term because in a sense they are being raised, and these two are also going down. Just like the return on equity is going down, these two are also going down. Most likely a part of it is because of declining profitability itself, which we have zeroed down on rising costs and interest components which come in. Maybe there is a lack of efficiency as well, which has come in because of more capex. So we'll have to zero down on exactly what is causing this in a moment, right? But yes, return ratios are not healthy. They are going down as well. Let's look at interest coverage. That's EBIT by interest, right? So EBIT divided by the interest component. That's good in the first year, but declines over the period of time from 14 to 6. 6 is still comfortable, assuming that your interest component is correctly defined there. If the interest is defined in terms of what is only the accounting expense on account of interest, but actual interest is different, we'll have to check that. So just check interest. One way of checking interest is actually here itself. I will just go down a little bit and put up interest cost. How do I find interest cost? Is interest divided by total debt, right? So let's look at interest and divided by the sum of the total debt, which is this plus this. And we see that ideally they should be paying about 8% or so. They seem to be paying lower amounts earlier, but seems to be reaching around 8% here towards the end. So that's fine. Was historical lower amount because of some sort of capitalization of interest, which is treatment of interest as a fixed asset because it was used for the purpose of capacity expansion. We can check that in the annual reports as we go along, right? So that's this bit. What is debt equity? Debt equity is the sum of the total debt, which is long term plus short term divided by the shareholder funds, that is equity. And similarly, debt by assets is long term plus short term divided by total assets. I could have taken total liabilities as well because both of them are the same, right? And I drag it on the right side. Debt equity rises marginally over this period. Debt to asset ratio is particularly more or less, stagnant as such. So that gives us the analysis for these data points. We'll see about interest in a little bit more detail, whether it is getting capitalized or not. Let's quickly finalize fixed asset turnover ratio as well. What do? We take the P&L, which is the sales number, and divide it by the balance sheet assets number, total fixed assets number, to see what's the turnover ratio that seems to be like. Turnover ratio goes down. This usually signifies capital expansion, and especially in industries like cement, which take time to kind of do capacity expansion. It might take 2-3 years before the capacity comes on stream. So it's possible that they have done a lot of capacity expansion, but that is not really producing anything right now, right? Capital expansion yet to produce sales out of that, right? So that's a possibility. If you read about Ultratech, you'll find that is indeed what has happened, that they would have increased capacity over this period from a certain capacity to a certain number. If you want to check that out, let's look at the capacity in 2012, right? So if you look at the annual report for these guys and try and look at their capacity in 2012, this is the 1213 report. 1213 report will tell you the capacity somewhere in the annual report itself. They would have given a letter to the shareholders. Here, management discussion and analysis. It says installed capacity for cement is about 48 million tons in 2012, right? If you look at the management discussion and analysis, it says installed capacity for cement is 48.75 million tons that we see in terms of the number there. But let's try and see what this number is in 2015. The company says they have done some, commissioning of brownfield. Capacity has risen to 63 million tons, right? So that gives you a fair bit of an idea that capacity has gone up from 48 to 63, which means fixed assets would have gone up. But in cement, if the industry is not doing well, which seems to be obvious with the sales not really increasing as much, it appears that the production out of that entire data set is not coming out, right? So capacity utilization is not complete for these guys at this point of time. You could try and search what is happening with capacity utilization in cement, right? So just try and search for this separately beyond this section, this class, and we'll get a sense of what's happening with capacity utilization and whether that is kind of creating an issue here or not, right? So that's the first part that we realize that we do. The other things that we do is we go to the financial statements here. Now we've used standalone statements here. So I'll try and search where the standalone statements are, and we go and look at those in more detail to understand. So 2014-15 standalone statements would be on page number, so after the auditor's report, page number 106, 7 onwards is where the statements would come in. Page 110 in the annual report showcases the balance sheet. This is the standalone balance sheet, followed by the consolidated ones will come later. Now, here in Ultratech's case, standalone versus consolidated is not very different. There aren't too many subsidiaries, so we kind of fix our data points on standalone itself. If there is a big difference, you look at consolidated data points, right? Now let's go ahead and look at what's happening with their interest component. So one of the ways of finding out whether or not there is some sort of interest capitalization is that your interest cost here accounted in the P&L is 547 and 319. Now, typically, while it is allowed under various accounting standards to report interest component as operating or financing expenses, usually it is put in under financing expenses, cash from financing activities. So what will happen is first they will add it up. So whatever was the exact interest expense gets added back to your profit before tax. So you are essentially adding this back because you already subtracted this to get to profit before tax, right? So you add this back. This is the same number that you would have seen in the P&L, 548 and 319. If you go to the P&L, you will see 548 and 319. Exactly same numbers is what we see there, right? Now let's see what happens on the cash flow from financing activities. Is that number materially different? So when you go to cash from financing activities, interest paid for this year is almost similar. That's 549 versus 547, 548 we saw earlier. But last year, the interest paid was more. It was 404 versus 319 which was recorded, right, as accounting. So what's happened there? And that possibly explains why your cost of interest is lower last year. You should have put in 404 there while calculating it. So let's look at this. Do they give details of finance costs? Finance costs are put in detail in 28. In note number 28, which follows these statements, you will find the finance cost available there. Let's go and look at this finance cost there in note number 28. Just follow this, keep following this, go to the different pages, note 11, 12, 13, 14, 17, 21, 28. So that's your finance cost that is available, and it tells you a few things about what is the exact finance cost. This is the interest expense. Details of this is given. So this year, your total interest expense should be 588 plus other borrowing cost, which is 4. So you should have calculated your interest cost as a percentage of debt on 592 or 593, rounding it off, right? Some finance costs got capitalized, that is 45.74. When we say this got capitalized, this essentially would have gone into either fixed assets or in capital work in progress. Now, can you find it there separately? That you will not find, because capital WIP is just one line in the balance sheet. If I go back to the balance sheet, you will find that in the balance sheet, you have what is called as capital work in progress. If there is a movement so this is where you see capital work in progress. If there is a movement of interest from interest cost to capital work in progress, you will not find the details there, but you found the details in note number 28 there, which basically explained you where did the interest cost go. So essentially, the interest component would have been classified under these capital work in progress, which is essentially if you have used the interest for that particular purpose. So the actual interest cost is available only if you go and look at these finance costs and the notes to the accounts beyond that. That is where you will find out what has happened to the actual finance cost of the company. And that note 28 is where we are going to look at it in more detail. And that note 28 tells us that the actual interest cost is 588 plus 4 and 396 plus 7. So somewhere in our sheet, if we want, we can put in the P&L itself, actual interest paid, and for the last year this was, for example, 588 plus 5, and for the year before that it was 396 and 7, so 396 plus 7. And now you can go to the ratio sheet, and instead of using your interest cost as PNL D31, we can change this number to 403. And sorry, this is D403 that we have looked at, and we have connected it here, right? The earlier two we have not yet calculated, and similarly here. So we get 9.1% as the cost. That gives a better realistic understanding of what's happening. Similarly here we'll convert it to D40 and D40, sorry, PNL E40. And we realize that interest coverage ratio also goes down a little bit. So there seems to be some sort of a movement there as well. Let's quickly turn our attention to Dupont Analysis, which is what is going to break the return on equity into net profit margin, asset turnover ratio, and the leverage factor, or what is also called as gearing in a business, assets by equity. This is NPM, which we know. This is asset turnover ratio, which again is calculated up there. Leverage is nothing but assets by equity, right? So let's link in a couple of sets. Net profit margin is available here. That's PAT margin. Asset turnover ratio is also available in turnover ratios. That's here. Asset turnover ratio. What is assets by equity? We go to the balance sheet, click on total assets divided by shareholder funds. So we get assets by equity. That's this number. Select these two and format. Select these and drag. When you drag these and you multiply these three, so the product of these three numbers is what we are looking at, and we get 19%, which is going to be exactly the return on equity that you saw here. So ROE going from 19% to 10.7, that's what we had seen here. ROE going from 19% to 10.7%. Now we can find the breakup of what is causing that, right? So asset turnover is taking it down. That is one part. So capacity expansion is causing it. Net profit margin is going down. That's causing it because your industry is not doing well. So you're not doing enough sales, or costs are rising more than sales. So that's the second part that creates a problem. Gearing is not really a big issue. It's kind of stagnant or more or less standard, right? So to take back ROE up, they have to improve utilization to increase ROE and improve margins to increase ROE. That's the broad analysis that you do on the return on equity part as well, right? This company does not have too much debt. If it had a reasonable chunk of debt, it pays to also go and look at the balance sheet and find out where is that debt coming from, right? So if you look at the balance sheet and you look at long-term borrowings, this schedule 4 in front of the long-term borrowings, or note 4 in front of the long-term borrowings, is what is going to tell you about what the breakup of these borrowings is going to be, right? So let's search note 4 and see if we find anything in note 4 for borrowings. Long-term borrowings, how much is secured out of that 4,000 crore, how much is unsecured, and how much is in foreign currency. You have the data available in terms of foreign currency loans as well. So you realize roughly about 1100 and 1500, that adds up to about 2700, which is more than half of their loan is in foreign currency. Why is a foreign currency loan important? Is because if you find that the currency of India depreciates, you borrowed money when rupee was at 60, when you repay money if rupee is at 70, you have to repay more. So while interest cost might appear artificially low because you have a foreign loan on your books, the actual interest component could be higher because you might end up paying a higher principal. There could be a loss on the principal part itself if the currency goes against you. So it's always good to know how much foreign currency loan do they have, which is again available in the notes to the accounts, right? Let's quickly go back and put in the cash flow numbers as well. All we are required to do is we're going to put in on the cash flow sheet cash from operations, cash from investing, and cash from financing. All we need is these three headers just to try and gauge what the company is doing. Where do we find this? 2014-15 statement, cash flow statement. Net cash generated from operating activities 4083 3242, right? So going right to left, 4083 3242. Similarly, put in the numbers for cash from investing activities, used in investing activities, negative 1880 minus 1880 and minus 2210. They seem to be doing capex, right? Go further, financing activities minus 2266, right? Minus 2266 this year. So that's minus 2266 and minus 897. They seem to be repaying money here as well, which is interesting because their loans seem to be increasing. So there are some transfers of borrowings which are happening, which we need to probably dig a little bit deeper at a subsequent level of analysis, not at this point. But yeah, that tells us something about what the company is up to. Let's look at 12-13 annual report as well, and around page number 86, 87, 88 is where the financial statements are. 88 Net cash generated from operating activities is 3573 and 3458. So we put in 3573 and 3458. That's good. Let's go down. Minus 4302 and minus 2942. Minus 4302 minus 2942. They've done a lot of capex, which is why everything is negative all this while. Financing activities 683 positive here and 471 negative here, minus 471 negative here, right? That's your cash flow scenario. It seems that their cash from operations is good. They continuously generate reasonable amount of cash from operations. They are doing a lot of capex, and the company seems to be reasonably healthy on a cash analysis basis. That's not under any kind of trouble. So that kind of freezes what analysis we had to do. This is more a guideline on how do you go about and work in your project. That's the broad idea, that you replicate what we have done right now in the actual project that you're going to work on. And we would recommend that you essentially do this and more in terms of you're trying to find out what is the analysis of the company going to look like, right? You do need to find the reasons of certain trends that are being established. That's it from us.